Hey everyone, welcome back to Corporate Decoder, the place where we dig through corporate filings so you don't have to. Today we're looking at Entrepreneur Universe Bright Group's latest quarterly report. Get ready for some twists because this company's structure is more complicated than a TikTok dance craze, and the numbers might not be as bright as the name suggests. Before we get started, if you like getting straight insights from corporate documents, make sure you're subscribed to the channel. We also have a Discord community linked in the description below if you want to chat about this report or anything else business. So, Entrepreneur Universe Bright Group, or AUBG, is a Nevada-based holding company, meaning it doesn't really do anything itself. Instead, it owns subsidiaries, or smaller companies that actually run the business. In this case, those subsidiaries are in Hong Kong and China. This structure is important because it means investors are buying stock in the Nevada company, not the Chinese companies that are actually making the money. That's where things get a little tricky. The report clearly states that shareholders won't directly own equity in the Chinese operating companies. This is a crucial point because it adds a layer of separation and potential risk. And they even admit it. The company acknowledges that this holding company structure involves unique risks to investors. Chinese regulatory authorities could decide they don't like this setup, which could mess with the company's operations and the value of its stock. There's a warning that the Chinese government could exert significant oversight and discretion over the company's business because substantially all of our operations are conducted in China through our PRC subsidiary. The PRC government could also significantly limit or completely hinder our ability to apply to list and/or remain listed on a US or other foreign exchange and to offer future securities to investors and cause the value of such securities to significantly decline or be worthless. Adding to the worry, there's a whole section discussing how the Chinese government is cracking down on companies listed overseas. This could significantly limit or completely hinder our ability to offer or continue to offer securities to investors and could cause the value of such securities to investors and could cause the value of such securities to investors and could decline or be worthless. So it's probably something to keep in mind. Alright, now let's dive into the numbers. I am scrolling to the balance sheets. Here, we can see what the company owns and what it owes. Digging into the numbers, accounts receivable, which is money owed to the company, is around $316,000. This means they are worse at collecting money for what they do versus last year. The company's property, plant and equipment, which could be anything from computers to vehicles, is around $42,000. This number is important because it shows the amount of investment they have in themselves, which is not much. Also, they have deferred tax liabilities around $266,000. In simple terms, this means they have some taxes they need to account for. Now, let's look at the income statement, which shows how much money the company made or lost. I'm scrolling to the statements of operations and comprehensive income. First up, revenue. Revenue came in at about $961,000, about a 24% drop compared to last year. That's like losing 1 out of every 4 customers. Not great. Gross profit, which is revenue minus the direct costs of providing services, was about $789,000. Again, that's down compared to last year, showing the company is less efficient or charging less. And finally, net income, the actual profit was around $183,000 compared to $73,000 last year. This means the company lost about 50% of its net income. Let's scroll down to the cash flow statement, which tells us how much cash the company is actually generating. Looking at the cash flow statement, the net cash generated from operating activities is around $424,000, which is about the same as last year. It shows that their ability to turn sales into cash is not improving. Scrolling to related party transactions, the CEO's family's company gave them $1,945, not really anything to be concerned about. Digging into the risks, we see that one customer accounts for 64% of their revenue. That's super risky. If they lose that customer, they're in big trouble. It's worth mentioning is that the company has not incurred any costs to obtain contracts. Finally, they are being taxed around 25%. Keep in mind this can always change due to the changing geopolitical relations with China. Now let's put this all together. It is risky to invest in a company with so many concerns and a declining revenue stream. This company needs to diversify its customer base, get more efficient and clear up some of the regulatory concerns. Alright, that's our breakdown of Entrepreneur Universe Bright Group's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.